Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here, home studios, May 2nd, delivering today's podcast on the heels of yesterday's Fed meeting with Chairman Powell. All kinds of stuff to talk about. We're right in the middle of earnings season. Tons of data to share with everybody here today. Welcome back to the show. As it's only been a week, we usually spread these out, 2 weeks at a time. Thought it was appropriate to go ahead and hop in here today on this Thursday after the Fed meeting to kind of share some thoughts, our perspective, market reaction, and kind of what we're actually doing here for folks at Shepherd Wealth Management. So jam-packed show, ready to get going. How about yourself, man? How's your Thursday kicking off here?
Oh, it's popping. It's banging like the Hilton over here in Louisville, Kentucky. So, yeah, I'm ready to do it, man.
I guess so. But we got to touch on a couple things outside of finance because we just do. NFL draft just completed. My Bengals took all 10 of their picks, and very excited about that. I definitely give them a strong B. Only reason is they are very much like myself here. They're taking some risk with some folks. You can call it risk with their investments, if you will. And I think they're going to pay off big time here. So there's a ton of upside for the risks in which they're taking, which is exactly the type of risk reward I'm looking for as an investor. And therefore, I'm very bullish on their prospects, not just for this year, but for the future. But those are my big takeaways on the NFL draft. As you got anything stood out to you?
You are the NFL maestro in my life, so I totally defer to your judgment on that one.
This is true. You're the maestro for all things related to the NBA.
Yeah.
I would definitely take that mantle for the NFL. So looking forward to this season. I got to do a real quick one, though. The third round wide receiver out of Alabama, Burton. Everybody had him pegged as like the fourth best receiver, but he has some off-field like character type of concerns. Obviously, the Bengals are very much a character-oriented type of organization with the players they pick. You saw it in this year's draft, too. You've seen it ever since Zach Taylor has been the coach. 5 of their 10 picks were team captains. They're typically going for a team captain, obviously a really good athlete, good personal traits as well. So I like it, even though it's a risk. If you can keep the guy on the field, he probably will, potentially be one of the better receivers in this entire draft, and they got him in the third freaking round. So hopefully that culture that they built in that locker room will keep that guy's, head straight, on a level situation. So looking forward to it. I'm already can't wait till training camp kicks off and obviously the season in September. So that's my take on the draft. Very excited. But you're in Louisville as we got the Derby coming up, man.
We do. Sunday. Some may say it's already here. It's that close. So it's about 48 hours from now. Yeah, everybody will be heavily into their third or fourth round of mint juleps and or lilies, and who knows what happens.
No, I wish I could. As in our family and friends, it's a big weekend for all of us, and we love the Derby. Unfortunately, I made a blind decision. Some neighbors of mine were like, "Hey, let's do the Flying Pig, the half marathon." I've done several halves. I've done the actual full Flying Pig marathon. That sucked. That was extremely painful. If I ever want to run another marathon again, although I do have it under my resume, I'm happy it's over with and my shoulders. But I'm usually down for a 13-mile run. I would have never signed up for it had I known it was the day after the freaking Derby, because to your point, I would love to enjoy some mint juleps, relax, have a good time. Bet a very, very small amount just to keep things interesting. My wife usually wins anyway because she picks the favorite color, and that seems to work out for her more consistently than actually looking at any sort of statistics on the race itself, which is what I do. So don't take my words on whoever's going to win the Derby here. But 6:30 in the morning start time right after Derby day. So it won't be as fun of a Derby day for me as it otherwise might have been. Nonetheless, I'm doing it with friends. So, I'm taking one for them, I guess. So we'll make some adjustments to next year's schedule as far as that's concerned. All right. So we want to kick off today's show with a couple of viewer questions. I meet with customers every single quarter. So for those that are just listening for the first time, checking us out, You'll find a ton of information, shepherdwm.com, about, who we are as a company, who I am as a person, as well as an advisor. And you can also find all of our podcasts, all of our blogs, newsletters that we post and send out to customers on a monthly and weekly basis. All of it's right there for you, even if you're not a customer, just so you can kind of get a feel for what we're all about here. And one of the things that makes us different is we literally sit down with every customer every single quarter, kind of keeping ourselves here at Shepherd Wealth Management accountable to performance and service and understanding their needs. And if any of that has changed, all that's very important to us. Clients love it as well. But we also get questions during these quarterly reviews. I want to share some of these questions with you, give you my take on it, and then we'll certainly hop into the meat and potatoes of today's podcast. Because if I'm looking at this, like if my customers have these questions, I'm sure some of you out there do as well. And all this stuff, at least the first question here, is always subject to change because it has to do with inheritance. And we're going to see some potential tax law changes 2025 and beyond, just kind of depending on the outcome of the election. However, one of the things that came up in a quarterly review, hey, I have inherited this retirement account, an IRA, a pre-tax IRA, and they were under the impression that they had to take out, 1/10 of the balance of that account every single year and deplete the account over, by the end of that 10-year period of time, which is actually, accurate. That is, in fact, accurate, but there were some adjustments to the rule. And the adjustments have been this. And of course, you can always run this by your CPA. We have our own here at Shepherd Wealth Management. Happy to get them involved if there are very specific questions. You want to hear it right from the horse's mouth, so to speak, from a qualified CPA. But the rule is this. Yeah, if you inherit an IRA and that person that passed away is over the age of 73, so they're required minimum distribution eligible, meaning they have to take out a certain percentage of their IRA every single year after the age of 73 and beyond. And if you inherit the deceased IRA under those circumstances, you do have a mandatory required minimum distribution that you do have to take out, and you will have to pay taxes on it. But the short and sweet of it is you can, in fact, instead of taking out 1/10, which is certainly going to be more than your required minimum distribution withdrawal. Now, if you need the money, that's one thing. But if you don't need the money, this is where the advice might come into play. So you have the RMD, you have to take it. But instead of taking 1/10, you can actually stretch that out over 10 years. So here's the example. My customer is still working. So inheritance happened. They're still working. Yeah, they have an RMD they have to take out and pay taxes on. I can't get them out of that. But they don't have to take anything above and beyond that. They can actually wait until year 10, and whatever's left in that account, other than their RMD, they can just take it all at once, right? And the beautiful part for this particular circumstance is while the customer's still working, yes, they have to take the RMD. There's no way around that. But instead of taking all that extra money out and paying taxes on it, they can leave it in the IRA. They can keep it invested, keep it growing, keep it compounding for them. And then in this specific customer's instance, they will be retired before that 10-year window is up. So the smart thing for them to do, because while they're working, of course, they got a paycheck, they're going to be in a much higher tax bracket while they're working. But as soon as they are retired, now they can look at whatever the rest of that IRA balance is and make some decisions. The RMD can't get them out of that. You do have to deplete the account by the end of that 10-year period after you inherited the money. But you could literally wait all the way up until that year 10 and take the funds out then. You could take out a smaller amount and spread it out over the years while you're retired as well. So a lot of different ways to play that. A lot of people think you just have to take out a 10th. That's fine. If you want to do that, that's totally cool. The government's not going to complain about taxing your money. But if you'd like to delay that, there's some strategies in which you could do so. That makes some sense if you're working and you inherited something. But if you inherit something, you're not working, that's pretty attractive as well, because you still have the RMDs, but literally you can wait until you're 10 to take out whatever might be in that account, kind of spreading out that tax liability as much as you can. That was something that came up. The other thing that came up was a question that I asked myself jokingly every earnings season. We're right in the middle of earnings season. We're going to talk about that in some detail here, but I feel like everybody has this question. The question was this: so we're seeing some really strong earnings, which were expected, not just this year but this quarter. But the question was this: why do stocks go down on good earnings? That's a legitimate question. Because I'll give you a good example. We talked about it in our last show last week. Meta, Facebook, doubled their earnings. Margins were up 27%. I mean, everything that you would want to see have happened for a company in that space, they knocked it out of the ballpark. I mean, they just crushed every metric. The reason why the stock went down so much so quickly after their earnings is because, and I wrote this to a letter to customers, I said the CEO was just too honest. He was just very honest about the fact that this artificial intelligence thing is adding revenue. It is adding to their margins right now. That's a big part of their success in doubling their earnings and revenue over a 12-month period of time. And it is an arms race for this thing called artificial intelligence. So let me give you a good little simple example here. Facebook, they had almost 3.3 billion people on their platform, every single day. The global population is 8 billion people. Okay. The only reason why the other people don't have, their product, that being their platform, Facebook or Instagram or WhatsApp or all the other things that they do, 3.3 billion people. The only reason why other people don't have it is because, they don't have internet or they don't have a smartphone or, they might not even have a car. They're on camels or horses or whatever the thing is. So they're using all of their data on half of the planet, right? That's a huge sample size. Data would be a big deal. Everybody remembers the phrase big data. At least that was like a huge buzzword when I was in college, big data.
Oh, yeah.
It is, in fact, still important to have all that information, but here's what artificial intelligence does. It takes all that data. So Facebook's primary source of revenue is marketing. And if you are a company with a product or service you're going to market, like a national campaign, you're going to go to one of three places. It's going to start with Google and Facebook, 1 and 2. Pick your order. The third one is going to be Amazon. You might do some other stuff, outside of those three, but those are your three big players. So we're sticking with Meta, Facebook as this example. 3.3 billion daily active users, decades worth of data on half of the population on this planet. And they're going to use artificial intelligence to make their ads more specifically targeted, therefore more effective. That's attractive to those that are doing these national marketing campaigns. Of course, you want the highest return on your investment for every dollar that you're spending on marketing. And if Facebook is able to show statistically with this program, with all this data and the way that we build our artificial intelligence, the investments that we've made to make this happen, they can now sell more ads more effectively, which will actually increase not only their margins, their revenue, and their profit. That is the sole reason why their CEO was so honest in saying, hey guys, this is probably going to take another billion or two than we thought of investments into chips and our infrastructure so that we can in fact dominate, not only dominate social media, but dominate marketing, increase our motive safety, all the things that you would want to actually see not only a strong business do, but a strong leader, having the courage to go ahead and say, hey, this is, something that we need to step into, as opposed to, reducing expenses. Now, if he just said, we crushed it, we're going to keep crushing it, our expenses are going to stay the same, the stock would have done the exact opposite of what it did. I think it was down like 10% after earnings, or worse, maybe up to 14%. It probably would have had the opposite, reaction. Now it's doing kind of fine. It's finding its footing again here, on the heels of some really good earnings from Amazon and others. We'll get Apple at the end of the day today. That's a huge one, of course, biggest stock in the whole market after the bell. I'm excited to hear what those guys have to say. But nonetheless, that's the reason why a stock can have great earnings, yet still go down significantly. It would have a lot to do with the guidance, the CEO and the CFO. Other example, Tesla did okay on some of their earnings. They missed some, they hit some. Their margins are down again. Their production is down again, but their stock was up like 4 or 5% after their earnings announcement, simply because Elon Musk was talking about the future of what they're going to be able to do with their product or service. So it is a great question. It's a tough head scratcher at times, even for me. And this is what I do all day long, every single day. I'm all about it. But it's a legitimate question. There's a lot of components that come into that of why a stock might do whatever it's going to do after its earnings, which means if you're an investor and you're very bullish, let's say you're really bullish on Apple coming into their earnings, It's you could be right long term for sure. Like, why not? If you're not in Apple in a bigger way, it might not be a bad thing to consider here, given their stance in the technology world as it relates to products and new ideas that they're coming out with all the time. But just because they have a good earnings doesn't mean their stock price is going to go up. They could have bad earnings and their stock price might actually go up, as I mentioned here with Tesla as an example. So you have to be cautious. I really at times want to step into positions in a big way before their earnings because I expect actually I did this with Meta. Own customers stepped into it big, expecting the quarter that they gave, and we got it. We just got the guidance that was directly honest, and we took it in the shorts for a couple of days there. So,
Yeah, I
good
feel like
question.
that's been something we've seen a lot in the past couple years, especially with the on paper recession and interest rates. You've had a lot of really amazing earnings reports, but that hasn't necessarily translated directly into an immediate bump in the stock price.
100%. So I thought it was a solid question.
Yeah.
Everybody probably asked it, and there you go. That's kind of our response on it with some real life examples here as of recently. So I get the question, and keep them coming. By the way, you can send questions directly to us. Just go to, again, the website, shepherdwm.com. All the ways to get a hold of me are there. And you can even drop them right in the YouTube live, right? Right, Ez?
Yeah, absolutely. We take questions in chat. So for those of you that are listening to us live, and those of you that are hearing this specific episode later, either on Spotify or on YouTube, drop comments for Joshua in the comment section, and we'll either answer them directly to you with a DM or in a future episode. So.
Excellent. Thanks for the plug, Ez. So here we go. We got some data here to share with everybody. So it was a tough April. I'm going to talk about a little bit about how April went. I'm going to write about it tomorrow. So for those that are customers, we do a monthly newsletter. I try to get it done during the first week of the month. So I guess technically I have all weekend to do this, but I'm going to try to knock it out tomorrow. Really what we do in the newsletter, try to do is give you guys, not only what happened in that prior month, in this case it would be April, but what does history have to say about it? And I'm going to touch on some of these things today, and I'm going to write about it, in the newsletter. And we do make that public. So at least for now, I'm giving you guys, those that are not customers, right on our website, shepherdwm.com. Our weekly blogs are there. Our monthly newsletters are there. I might not continue to do this, forever. I will definitely do it forever for our customers, but for all you guys who are trying to piggyback off the research, I might have to cut you off. So just keep that in mind. But yeah, tough April. So coming into the last trading day of April, the S&P 500 fell 1.6%. NASDAQ was down 2%. The total loss for April on the S&P was right at about 4%. But here's the deal. Over the past 40 years, the only worst April return was in 2012. And you'd have to take a big step back in time there. There was a debt downgrade in this country. A lot of you might have forgotten about that at that particular time. So that was April over the last 40 years, except for April of 2012. And after a strong first 3 months of 2024, so make no mistake about it, I know that we just finished April. 1/3 of the calendar year is freaking gone. Okay. But the first 3 months of the year were actually really, really good. The markets were up approximately 10% on the S&P over that period of time. Now, many are wondering if the decline in April is the start of a broader, quote unquote, payback period where stocks will languish. And you hear all the time, sell in May and go away sort of phrasing a lot. And I think that that's the wrong way to go about looking at this when you take a look at what history has to say. But first of all, let's talk about the sell-off. So the sell-off on the last trading day of April was definitely due, in my view, to a, quote, hotter first quarter employment cost index. So the cost of employees, right? That number came in at 1.2% quarter over quarter. The analyst consensus was looking for 1%. So what the fear is here coming at the end of April was that the cost of employees going up is going to keep inflation front and center as a concern for the Fed and the overall market. Now, that was the news, okay, that caused the huge sell-off. I just gave you the numbers there. The problem with the news, the reason why we do this show, and I'm about to make this very clear here in just a second with some actual data that nobody talked about, but the reason why we do this show is not only for those who are not customers to get a feel for who I am, as an advisor, as a CEO, as a person that really, really, truly cares, um, and making sure that you guys are getting the types of results you need and deserve as individual investors. What the news does a good job of is telling you what the problem is, right? That's what gets eyeballs on the screen. There's actual science data behind all this. And the science is behavioral finance. You can literally get a PhD in this topic at every major university. It's fascinating. In a nutshell, it just describes how human beings make decisions under stressful circumstances. And what we've learned from that study is human beings feel losses twice as much as they feel good about a gain. It just means that we are risk averse by nature, specifically when it comes to things like money. If we're concerned that we're going to lose some of our nest egg for whatever the reason is, Fed, interest rates, stock market, volatility, war, whatever your fear is, you tend to want to hang on to that, as opposed to doing some research and trying to figure out what other human beings have done in the past. And that's what we do here. The news does a bad job of saying, hey, here's the problem. And we try to follow up the problem with, hey, how many other times in history have we gone through something like this?
Right.
Right. And because the news understands that we're a little bit more fearful than we feel good about a gain, they placate to that so they can keep eyeballs on the screen and sell marketing. That's their job. I'm not knocking them for doing their job. And some reporters are better than others at some of the stuff that we try to do a good job of providing historical context. But that's what we're here to do, is provide that historical context. So with that being said, this employment cost index was hotter, quote unquote, than expected. And that caused some volatility in the stock market. So here's what the underlying information is that the news did not talk about. So our wage pressures actually accelerated in the U.S. economy. Of course, would imply this based on the number that we just received. However, what really caused this was union pay surged in the first quarter of 2024, but non-union wages decelerated. I didn't see one person on TV or in a Barron's article or any of this stuff that I follow, which is probably more than everybody watching the show. Nobody, not one person, talked about the union pay surge. Now, this is very clear. Last year, we had all this union stuff, right? Specifically, in the auto world. All that stuff actually takes effect, sometimes instantaneously. Some of that is a delayed effect, and that's what you're seeing here. Union pay surged, non-union wages decelerated, right? So this is something, again, that nobody talked about. And I guarantee you, if this was brought up after that employment cost index number came out, have seen the type of sell-off that we saw right at the end of April. So it's unfortunate, but that's actually what has occurred. Now, another thing that I found interesting that, again, I haven't seen one person talk about except for Tom Lee at Fundstrat. We're a big Fundstrat fan here. A lot of the stuff that we get from a data standpoint, at least oftentimes, will come from these folks because they really take their focus from a research perspective on history. Now, why is that important? What history shows us is it's just putting probabilities in our favor, right? The past is no guarantee of any sort of future result. Investing involves risk, including risk of loss. For all the compliance people out there. But the short and sweet of it is if we understand what other human beings have done in the past, now we can start to put probabilities in our favor. That should keep your blood pressure low, right? Your temperament is a big thing that Buffett talks about, as he famously said, the number one reason why individual investors don't achieve the result that we're looking for consistently is because they don't have a way for controlling their temperament. So how do I control my temperament is looking at what other humans have done in very similar circumstances and getting a feel for what the probabilities are for success over all the sectors to invest in. Now I can start to figure out how I want to adjust my asset allocation. So the two things that we can control as individual investors are our temperament. I do that by looking at history. And once I understand the probabilities, now I can control the other thing, that's the asset allocation. That's just a fancy way of saying this is how much of your money is invested in stocks versus bonds and cash. And asset allocation actually will provide you 94% of the variability of performance over any period of time you want to look at. So those are two crucial things to get control over: temperament and allocation. So that's how we go about doing that. One of the other things that was not brought up in the news, that was brought up a ton last year, And so we're going to look at a broad index here, the Russell 3000, right? So call it 3,000 individual publicly traded equity companies. The Russell 3000 companies' mention of inflation or cost pressures are now at 2-year lows. This seems to be at odds with the incoming data of first quarter 2024 that showed a pickup in inflationary pressures. And we think this is somewhat puzzling. Now, we kind of solved some of this puzzle. So last year, you saw almost in every earnings quarter, CEOs across all sizes talking about the inflationary pressures. Now that is at a 2-year low. I have not heard one person talk about that on the news except for Fundstrat. That would be the only one. And I think that was like a 30-second clip. And I have not seen it rerun at all. So I think this would really calm a lot of people down if they like took a step back to actually look at some of the history of all this stuff, which is why we're here. Now, the data coming in hot on inflation, we talked about it last week. So I'm not going to spend a bunch of time on it. You can go back and watch last week's podcast. It was a good one. But the short and sweet of it, a carryover effect on some stuff related to CPI, which is headline inflation. One of those things being, if you're going to increase prices for your product or service, you typically would do that in January, right? But not every company is going to have all their cost increases implemented by the time the government collects all this official data, right, for things like inflation. So you saw a carryover from January into February because of that. We also talked about the fact that there are two components of inflation that make up about 45% of the weighting on the index. And two of those things would be shelter and auto. That's about 45% of the CPI weighting, approximately. The other 55%, everything else that makes up that calculation, is running at a 1.78% year over year CPI. That's obviously below the 2% the Fed's looking for. It's actually below the 20-year average for all the other things outside of auto insurance and shelter. So very clearly, shelter and auto inflation is actually propping up the headline CPI number. And we're seeing that auto insurance had to happen because the cost of used and new cars during the pandemic went up substantially. We all know that. You couldn't hardly get a car, for that matter, during that period of time. And when those costs go up for new vehicles, well, their parts cost more money. The mechanics to fix the stuff cost more money. To ship all this stuff costs more money. Therefore, eventually, that cost has to be passed along in the form of increased premiums from insurers to fix all this stuff when you guys get in a wreck, or your car breaks down for whatever the reason is. Now, the issue with that is every individual state in this country has their own insurance agency, and if you're an insurer, you have to get approval in each and every state individually, one at a time, to be able to get approval to increase your auto premiums. So that's why you're seeing auto insurance premiums up 22% year over year from an inflationary standpoint. And shelter is coming down. It's just coming down extremely slow, and everybody knows why that is because of how they go about collecting that data. We talked all about this in our last podcast in some detail. And if this was the type of stuff, which is all true, all this is facts. Like, it's not my opinion. This is just the numbers and the situation. If this was what was actually talked about, I do not believe that we would have all of this fear. And I can see the fear, not just by looking at the VIX index, which is a measure of fear, but you can also just simply look at the fact that there's $6 trillion sitting in cash or cash equivalents, which is by far and away more cash on the sidelines, even more cash than was, in the sidelines back in 2008, 2009. So here's the data, folks. And I'm not going to be on CNN or any of the cool shows to give you this. So you're welcome for being a participant here in this particular program. So I did want to share some of that. We got to get to some Powell information, but I wanted to finish this thought here on all this data with some history, right? You get this temptation every May to sell in May and go away sort of idea. I'm sure you've heard of that, Ez. I'm sure everybody listening to this has heard of that.
Oh, yeah.
There's some context to it, but here's what the actual history says. May has been a surprisingly good month since 1985, or in the past 40 years. May has been positive 77% of the time. And excluding bear markets over that period of time, May has been positive 79% of the time. Moreover, when you have the first quarter of the year being positive, which is what we had, and April is negative, we had a negative 4% April. May has actually been positive over that 40 years under those circumstances, 83% of the time, right? So odds are certainly in our favor as investors as we are stepping into the very beginning days of May. Now, that's pretty much all the stuff that I wanted to provide you guys from a data standpoint. I'm going to switch over to Powell's comments. I'm going to talk about earnings and some stuff that we're looking out for here, in just the next couple of days. On Friday, we get a whole bunch of economic data relative to jobs and PMI release and all this other fun stuff. So let's go ahead and get to Powell S.
Let's do it. I've been waiting on this for all day.
So we got Jerome here, Jerome Powell. He is the Fed chairman. And they did get consensus vote yesterday. The hold rate steady between 5.25% and 5.5%. That was expected. Nobody was looking for any increase or decrease of interest rates. But the real question was, what was Powell's take on the hotter than expected inflation data, as I just referenced, that started this year? And what are they going to do about it? Are they going to increase rates, God forbid? Are they going to keep them steady? Like, what is their actual view for potential path towards the inevitable? Certainly hoping for, at least those of us that are constructive on the market, like we are here at Shepherd Wealth Management. So here's what Powell had to say, quote, "So far this year, the data has not given us the greater confidence. In particular, readings on inflation have come in above expectations." He goes on to say, "It is likely that gaining such greater confidence will take longer than previously expected." Powell said that he believes that monetary policy is appropriately restrictive today to get inflation down to 2% over time. It's just unclear how much time that will take. Now, he also said, from an economic standpoint, a solid economic backdrop with low unemployment and solid real gross domestic production growth means the Fed doesn't need to worry about lowering interest rates to rescue the economy either. We have some commentary from the chief market strategist at Lazard after Powell commented. He said, quote, "Jay Powell threaded the needle perfectly today. He reaffirmed the Fed's commitment to getting inflation to target while maintaining flexibility to ease policy if employment weakens meaningfully. He did not take the bait to talk about hiking rates, but clearly communicated instead the question is about when, not if, inflation will resume its decline." He's 100% right. Like I just gave you guys all the data from last week. I touched on it today. Powell, I'm not the only flipping person here in the finance world that's an advisor, that can see that there's two components of inflation that's propping up the actual headline number, right? Why he doesn't specifically mention this to the public is odd to me, because it's very clear. But he did not take the bait. He was asked directly about increasing interest rates, and I'm trying to find the exact quote here, but short and sweet of it is, they think it's highly unlikely that interest rate increases would be necessary. He was furthermore asked about stagflation. So stagflation would mean that we have a very high inflation reading with either no growth or negative growth from a GDP perspective. We don't have either of those things right now. The unemployment rate is 3.8%. Usually stagflation has a high unemployment rate, high inflation, and either flat to no growth, right? We have the opposite of that. So I don't know where that's coming from. Powell said that specifically. Is like, I don't see the stag or the inflation. So to be honest with you, this was the most favorite, news that Powell has given the markets in the last 2 years. I enjoyed the heck out of his comments, and the market loved it. So while we were actually, listening to the guy talk, the guy being Jerome Powell, market goes up 1% across all the major averages and then some. And then before the end of the day is up, it gives it all back. Except for the Dow was slightly positive. So it was a wild roller coaster ride. People were trying to game out, how many rate cuts are we going to get this year? The fact of the matter is that Powell still expects interest rate cuts. It was unanimous by everybody that's in the inside of the Fed. Therefore, I am still in the same camp. And when you actually look at the underlying data of all the stuff that we just talked about here today, you can kind of see where he's coming from. So I'm still very bullish on the year being a double-digit type of year. And looking forward to the back half of the year when we actually start to experience some of these interest rate cuts. I mentioned that all year long. We did expect a good start to the year. We got that, but we really thought the back half of the year was going to be where all or most of the gains would be had for individual investors. Now, as we talk about gains, we cannot talk about gains without talking about the current earnings season that we're in. And I'm shifting over to that right now. Pull up that data real quick. So we have 174 companies that are reporting this week. And of the 340 companies that have reported so far, that's 68% of the S&P 500, 80% of those companies are beating their estimates. And those that are beating by a median of 7%. So again, this is really, really strong earnings results. And you can understand why. I mean, this is a nation of consumers. That makes up 70% of our economy, by the way. And as long as consumers have a job, which they do, unemployment 3.8%, as we've already referenced, those that are looking for a job have one, and if they have one, their cash flow allows them to consume, so therefore they will consume. You would expect earnings to be stellar. The backdrop from an economic standpoint really couldn't even be any better, right? There's always some sort of geopolitical risk somewhere going on around the world, so that doesn't count, right? That's always there. You cannot diversify around it. It's just part of being a human being on this planet, and if you're an investor, you have to roll with that risk. But from an economic backdrop standpoint, if I told you, forget about all the other variables, if you just had an unemployment rate at 3.8%, earnings estimates are increasing, GDP is rising, and corporate profits have never been this good. Matter of fact, I do have some data on that I want to share with the group here real quick. This is the highest earnings surprise over the past 2 years, meaning that companies are surprising with their earnings beats in a much bigger and more consistent way than they have in the last couple of years. So you can see why Powell would talk about how healthy the economy is. If you just knew that, regardless of interest rates, which is obviously an important variable, don't get me wrong, you would be more than willing to be not only a participant in the market, which most aren't, again, $6 trillion still sitting in cash, but you would want to be pretty much fully invested all the time under these sort of circumstances. I mean, this is the perfect sort of scenario, other than the fact that we have the Fed funds rate hanging out at 5.25% to 5.5% in order to stave off any potential flare-ups in inflation after all this good progress that we've made on it. I am totally cool with Powell keeping interest rates right where they're at for the time being. I can make a very compelling argument for him to begin cutting sooner than later, but he did want to be more confident on the data. So what does it actually mean in my mind? He could be confident with one reading on inflation, but my guess is because they're Fed people and they're economists, they'll always say, well, one piece of data isn't, really what we're looking for. We want to see it continuous. So I'm betting that they're going to want to see at least 2 inflation readings trending down back towards that 2% target, which means we're going to have auto insurance and shelter start to decelerate as opposed to accelerating for all the reasons that we've already just talked about here today. That will happen. Auto insurance isn't going up forever, and certainly housing prices have come down from where they were over the last 12 months. Not back to where it was 5-10 years ago, but certainly much, much lower than what it was just even 12 months ago. So everybody understands all that. And under these circumstances, it's a perfect time to be an individual investor. Earning surprises, as I mentioned, highest in the last couple of years. Now, as we get over to Friday, so first of all, today we get a huge earnings announcement from Apple. The implications of the Apple earnings, cannot be understated. If you've been betting against Apple, saying the product cycle is now mature, all this other stuff, you've just been flipping wrong, for forever. I'm not saying there aren't periods of time where Apple's share price isn't down or flat or doesn't do a lot. But over the long shot, you've had people trying to call a top in Apple's business cycle, and they've just been wrong. So you're better off owning this as a core piece. It's a 7% weighting in the S&P. I believe it's closer to 11% weighting in the NASDAQ. It is the largest stock on the planet from a market cap perspective, and it's worth owning. Now, whether you overweight that relative to your benchmark or underweight it, it's completely up to you. I'm not giving you that advice, but it is a core holding here for us. It is an underweight at the moment, and depending on how things shake out here with earnings, it could be a much, much bigger holding from a weighting perspective for our customers. But what the implication is this. One, it gives you some idea on the consumer. If they're still willing to spend $1,000+ on iPhones, the consumers should be healthy. And I would anticipate that they are going to say that, given that we are a very low unemployment rate here. But the other thing that we want to pay attention to with Apple is their service revenue growth. That's been a huge bright spot on the last several quarters of earnings reports. I'd like to get an idea of where revenue is at, kind of their thoughts for the rest of the year. Revenue's been decelerating just a tad over the last several quarters for Apple. So I want to get some insights from them on that. And I also want to get some insights into their supply chain move, kind of shifting out of China specifically, but Asian markets for a lot of their supply chain, given the fact that they got caught up politically between the United States and China last year. China basically coming out and saying, hey, instead of buying iPhones, let's buy this Huawei stuff. Obviously, Apple doesn't take kindly to that.
Yeah, no.
Given the huge investment that they've made in that country, obviously it's an important market to them, for the size of their economy.
Oh, yeah.
But they shifted. Yeah, they shifted over to India. You're seeing a lot of other places, not as big as Apple, but also important players kind of shifting the supply chain around to places like India, Mexico, and Brazil. India is obviously, easy one to see. It's such a huge population, right? Most
Yeah, it's
people.
virtually the same as China, right?
Yeah, and they are a lot of poor spots, but their population is fairly intelligent, just a lot more so than some other places around the world that you could move the supply chain to. And they're hungry for better life, better opportunities. The political environment is very pro-capitalism, which is why you're seeing some of that shift towards that. So I want to learn a little bit more about that as well. I think that's a huge win for not just Apple, but companies that are doing that, diversifying their supply chains. That way they're not caught up, from a political standpoint between the U.S. and whoever they may be doing business with. So also looking forward to the employment results. On Friday morning at 8:30, we get U.S. employment report. The consensus looks like is looking for about, let's see here, 240,000. We've been running pretty consistently, right around 215. So this would be this number. Now, the other thing about market tops, if you're getting the market to sell off on good news, that can at sometimes be an indicator of a market top. But if we get a strong jobs number, market's still doing fine tomorrow, I have a very difficult time saying, hey, we're at a market peak here. I actually think the consolidation that we've seen here over the month of April is in fact a healthy thing. That way we can kind of push forward, to new highs as we move along the rest of the year and get closer and closer to that first interest rate cut that we'll see at some point this year. It's difficult to gauge when that'll be, but if we got to get at least 2 inflation prints that are showing that trajectory back towards 2% as an aggregate, not just for some of the metrics, but as an aggregate, I think 2 reports will get us really close to that first interest rate cut. Maybe the Fed wants to see 3, like an actual full quarter's worth of data before they do that. But my guess is if we get 2 really good inflation prints, May and June, I think that sets us up pretty nicely for a rate cut or 2 before we wrap up the end of this year. And that's kind of the last thing I want to leave everybody with. We will get unemployment rate, tomorrow. Everybody's expecting that to be unchanged. We also get ISM services. That's a big one for the industrial sector. They're looking for 52%. Would be great. It was previously at 51.4. So an increase in ISM just shows more demand from the manufacturing sector. And of course, that is a very healthy thing for our economy. So that's something we're paying very close attention to. I'd say the jobs thing. The jobs number is going to be way more important than probably anything else. But if we can get jobs good, that's certainly a healthy thing, especially if we have a good market reaction to that. But we get 2 prints in a row, and I think that we're going to be set up pretty nicely here for a rate cut, which, by the way, rate cut expectations, just to kind of leave everybody with this one. Pull up the data here real quick. So back in January 24, beginning of the year, market was pricing in 6.7 rate cuts. By the time we get to March, 3.4 rate cuts. A couple weeks later, April 15th, 2 rate cut expectations. As of the end of April 29th, 1 cut expectation. So it's changed a lot very, very quickly, which is why also you're experiencing some volatility, obviously in April. from a sell-off perspective. So they're pricing fewer and fewer cuts, and they're pushing them out farther and farther in the year. The market has essentially done a complete course correction. If you were expecting, let's call it 7 rate cuts, January, and then as of the end of April, 4 months into the year, you're only expecting 1, there's a pretty good chance that we're going to fall somewhere, not 1, greater than 1, but obviously not 7, right? Maybe not even 3. I think 3 might be a max. If you get 3 cuts this year, that would probably be the maximum, given the number of Fed meetings that are left. In that the Fed wants to be confident in that inflation is falling sustainably towards that 2%. They don't need inflation to be at 2 before they cut. They just want to be more confident in that. So they're going to get an opportunity to do that. But because they want to see a couple, inflation prints at a minimum before they consider, really cutting rates, I think the Fed wants to. They just need a couple data points to allow them to. And after 2, I think they'll get that. So I don't think it's going to be 1. I think it's going to be greater than 1. Probably not more than 3, just given how many more meetings we have until the end of the year. As I don't know what else to do for the public here, my friend. We've covered a lot of ground.
We've covered a lot of ground today. It's jam-packed with a variety of info. And we got Powell's, I think, admission that he's going to drop his indie rock folk album titled I Don't See the Stag, I Don't See the Inflation, with several of his previous, there's ex-frat brothers, I think that record's coming.
Yeah, sign me up. I'll help sell some of those albums. That was for sure, hands down for me, the best Fed meeting we've seen in a couple years. I mean,
and some of the most poetic quotes Jerome Powell has ever dropped ever. Like, it was amazing.
It was great. So I appreciated that. I love doing this. To keep the questions coming, that way we can keep addressing them. Hit me up 513-630-2664. ShepardWM.com, all the ways to get a hold of us. We'll do this again, most likely in a couple of weeks at this point. We'll be much, much closer to that next inflation reading, so we'll share all that information with you guys. So don't forget to check us out, like it, subscribe to it, get the little notification bell if you're watching this on YouTube. That way you know what's going on and when. And we'll do this again in a couple of weeks. With that, I hope you guys have a great rest of your Thursday. Have a great weekend, Derby Day.